President Trump out with a post on Truth Social this morning suggesting, there's the post right there, we move away from quarterly earnings. As someone in financial services, would semi-annual reporting be good for the industry and good for investors?
Well, I'm a big believer in transparency, so I think this would be better for companies than investors themselves. I also love rifling through data, so obviously I'm biased here. But I agree with you. I think something needs to change. Guidance seems to be a bit of a game among companies these days. And I'm not sure what that answer is, but I don't think it's reporting less. Of course, for companies, that means lower costs, so lower compliance burden. That could mean good things for the bottom line. But I think ultimately investors and markets and the efficiency of markets thrive on transparency, and to ask for less of that could be a net loss for all involved.
But Callie, would this perhaps make investors think more long term, instead of buying a stock 2 days before a company reports earnings, hoping it beats by 20 cents?
I don't think so. I think that genie's out of the bottle. I think markets have evolved in a way that allows investors to speculate as they see fit. I think investors are becoming more sophisticated too. So, the news flow will keep coming on no matter how much companies report. But I think that company reports are a good stake in the ground that you get quarterly, especially with guidance, that are really important, especially around more chaotic times like Q2, for example. I think about how markets could have reacted or how investors could have kind of spun up narratives without Q2 earnings season. And, that goes back to the importance of hearing from companies quarter by quarter and having them put truthful numbers out in front of us.
Allie, I think we could agree, though, earnings calls generally are dreadful. Very few companies do it right. One company I think does it right is a company like PepsiCo. They go right to analyst Q&A. I mean, most of these guys and folks are hopping up to these earnings calls, Allie, just reading off pre-prepared scripts that take up 30 minutes, and investors and analysts get no questions.
I agree, Brian. And as someone that has to sit through many earnings calls, it's very interesting to see how different companies do those. Netflix, for example, they release a video and it's all on camera, and they do really dive into those questions right away. And I think that's key. There's questions that shareholders have. There's questions that analysts have. That gives a lot of the rich context around some of these numbers, because at the end of the day, earnings are telling a story about the company. And as journalists, as reporters, our job is to really decipher what that story means for the investor. So I think the more data and the more color and the more context we can get on that, the better. And I'm all for revamping the typical earnings call.
What if earnings season only came twice per year instead of every quarter? It's a simple question with some big ramifications, and that's what we're exploring on today's Stocks in Translation. President Trump sparked the debate on Monday on Truth Social, saying that subject to SEC approval, companies should no longer be forced to report on a quarterly basis, but rather on a 6-month basis. He said, quote, "This will save money and allow managers to focus on properly running their companies." Now, first, let's break down what financial reporting actually is. This is the required scorecard, what a company earns, spent, owns, owes, and what's changed, so that investors can gauge performance and risks. Importantly, this does not include expectations for the future or so-called forward guidance. Look-ahead targets and commentary are entirely optional, as they always have been. Now let's rewind the tape and start at the beginning in 1934, when the Securities and Exchange Commission got the power to require periodic reports. It wasn't until 1955 that they actually gave a timeline, which was every 6 months. Then in 1970, the 10Q was born, which had to be filed every quarter. This also happened in Europe. Then in 2013 and 14, European and UK companies, they got some relief and were allowed to step down to every 6 months. But not many took advantage. A few years later, a study found that only 9% of UK companies actually reduced their reporting. Finally, in our timeline in 2018, back in the US, President Trump asked the SEC in his first term to gather comments from the public on stepping down to 6 months in the US. At the time, many corporate leaders weighed in, including the Business Roundtable and then PepsiCo CEO Indra Nooyi. They largely favored cutting down the reporting to be able to focus on the long game. But the point is, this issue has been around for years. Now let's set the stakes. If we cut reporting to twice a year, we're essentially trading less corporate homework for less information. That can feel great in the C-suite, but how does it play for investors? Well, let's focus on the pros first. Fewer filings can mean lower prep time and costs, meaning less make-the-quarter scrambles and more time running the business. For cons, there are fewer timely updates for shareholders, as well as bigger information gaps, which can favor insiders and pros. And it can also make raising money harder. Think of it as the price of money going up when investors see less. Now, what does the research say? Let's dig into that. One study found that more reporting means smaller jumps in price when financials are reported, and that it led to cheaper fundraising. But another study on smaller companies in Singapore found that making them report each quarter lowered their market value due to the higher cost. Another found that stepping down from quarterly to semi-annual led to less analyst coverage, which can disadvantage smaller investors. And finally, a study found that less frequent reporting led to bigger information gaps. Translation, the average evidence cuts both ways. Smaller companies can struggle with the burden, but markets generally like timely information, and context matters. So what happens next? Here's your roadmap. First, watch the Long-Term Stock Exchange, or LTSE, which has been vocal recently and is expected to petition the SEC. It's backed by Founders Fund, co-founded by Peter Thiel and Andreessen Horowitz. Expect a pitch framed around long-termism, as the name would imply. Second, watch the SEC's path. The agency already gathered comments in 2018, and it could now go straight to a proposal, but it could also run another comment period. Third, watch for investor pushback. Groups that prioritize transparency and fairness, they're going to weigh in fast. If you manage other people's money, you want frequent comparable data. And fourth, keep an eye out for white papers. If rulemaking moves, expect think tanks and consultancies to drop fresh studies about cost, liquidity, and how often investors really need updates. The bottom line is there are big trade-offs here involved, but we're going to keep tracking this issue as it evolves now that it's got some steam in it again. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Joining me now is Matt Maley, Managing Director of Equity Strategy at Miller Tabak. Matt, it is good to see you. So the president suggested, okay, maybe companies no longer should offer earnings reports every quarter. Maybe it should be semi-annual. Two questions, Matt. One, why do you think Trump is saying this? And two, what is your response? What do you make of it?
Well, to a degree, part of it's why he's saying it is, this whole idea of deregulation and putting less of a burden on companies. And of course, he wants to, let people or companies be able to focus more on the longer term rather than just worry about every single quarter and what kind of an impact that will have on their stock's price and maybe their bonus or whatever it may happen to be. But the flip side, of course, is that. As I said, it's a double-edged sword because we have less transparency for the individual investor. I mean, one of the things that the SEC is really tries to focus on, or certainly has over the decades, has been the individual investor. And so, if we have this fewer time, the institutional investor, they have these company meetings, and the big firms take these companies around to with their managements and meet with the institutional investor. The individual investor doesn't get that. So there's obviously a give and take there that could have some interesting impacts on the longer term.
It's interesting, though, Matt, because listen, I've talked to any number of executives over the years, as I am sure you have as well, and you will hear this sort of complaint, Matt, about the kind of quarterly cadence and this idea that they'll say, listen, it encourages short-term thinking, it discourages long-term planning. Are you sensitive to that criticism?
Well, I am to a degree, Josh, but the problem is that if you have a real good management team, and so many of these companies do have good management teams, they don't care about the short term. They care about the intermediate and long term. And even though it does cause them to do a few things here and there, but well-run companies don't worry about that. And everybody has ups and downs. The economy obviously has cycles, and so any company will have the same. But you can ride through it, I think. And I just think that, when we're talking about situations, the market's doing so well, up at all-time highs. Now we're worried about the Fed's independence. Now we're worried about transparency with certain companies, especially ones that might be trying to hide something. It's not necessarily the best thing in the world, especially for the individual investor.
Let's game this out, though, Matt, just hypothetical. Let's say CEOs did only report every 6 months. What would be some of the just practical, on-the-ground implications you think that could mean for the market?
Well, I mean, I guess the number one thing is what are people willing to pay for the risk that they're taking? And if they're only getting something every 6 months after having, getting them, 4 times a year, they're taking on more risk. Well, the stock market is expensive as it is today. Are they willing to take that risk? And it just, they'll talk about risk premium and things like that. It does raise some concerns in my mind, especially when you have a situation where so many things in the marketplace right now, anyway, that have indicated that a top of some importance was around the corner, whether it be high valuations, huge leverage in the marketplace, tight credit spreads, what have you, high speculation, what have you. It's the type of thing that does concern me a little bit. I don't think it'll be a catalyst to cause for a major top to take place, but it is something that could pile on to that issue that people should be concerned about, to be honest with you.
Are there any changes in how companies report you could get behind? For example, this conversation, it brought up this Jamie Dimon, Warren Buffett op-ed. I don't know if you remember, this was back in, I think it was 2018. And they talked about, Matt, how they were not in this op-ed, they were not opposed to quarterly earnings. They were not opposed to that quarterly cadence. They did emphasize their problem, though, Matt, with companies offering quarterly EPS guidance. They said that leads to an unhealthy focus on short-term profits at the expense of long-term strategy growth and sustainability. Do you agree with that?
I do, and actually wholeheartedly, because, one of the things is that we on Wall Street, I mean, that's what we're paid for, is to do that analysis, right? So, for the company to have to spoon feed the analysts all the time isn't necessarily what they need to be doing or should be doing. So I do agree with that. I mean, we'll have to work a little bit harder, but that's okay. That's what we're here to do. So, like anything else, there's good aspects to this proposal and ones that aren't so good. I think it's the end of the world if they start going to every six months. But those suggestions that Mr. Buffett and Mr. Dimon talk about, I think are good ones. It just makes Wall Street work a little harder, and there's nothing wrong with that.
Matt, always great to see and to have you on the show. Thank you, sir.
Thanks a lot, Josh.
We got a chance to speak to a few executives this morning and got their take on Trump's suggestion.
It's not a bad way to kind of incentivize long-term thinking rather than just a quarterly outlook.
I'd be okay either way. I do like the opportunity to talk to investors every quarter about the business and the future and the vision of what we're trying to do. But I do think sometimes the industry gets too obsessed with the quarterly numbers and infers too much forward guidance and forward momentum or lack thereof from a single quarter.
Sometimes I think when you're in a really volatile backdrop, you do want to be laying some of that groundwork quarterly. For me, that's less about the forecast and more just about providing color, just like what we're talking about the business. Yeah. That being said, I think we're all trying to find ways to free up capacity and make sure we're spending capacity in the most value-added areas.
Joining me now with their thoughts on the matter, Bill George, Harvard Executive Education Fellow and former CEO of Medtronic, and Bryce Tingle, University of Calgary Professor of Business Law. Thank you both for being here. I have to say, Bryce, what a coincidence. You wrote a piece for the New York Times, an op-ed that was published yesterday that just more broadly looked at changes that you think need to happen in terms of regulation of U.S. corporations. Then here comes President Trump proposing this. Do you think this specifically, the changing of the timing of reporting of earnings, would be a helpful change as well?
Well, I like to think I inspired President Trump. I think it's a good idea, to be honest. London has survived for centuries as an important financial center, and they use semi-annual reporting. I don't think we should be making rules about this sort of thing. I think shareholders and managers of businesses are perfectly capable of determining what the right reporting schedule is. I think there's a lot of companies that would benefit from lower costs associated with financial reporting and would benefit maybe from a longer term focus, that not having to sort of address quarterly performance every 3 months would permit. So I think it's a good idea.
Bill, you've been in that CEO seat. You've had to, be on this cadence, this hamster wheel, maybe, of quarterly reporting. Is it a blessing or is it a curse or somewhere in between?
No, I very much favor going to semi-annual reporting. I think you'll find most all CEOs do. To some of the comments made earlier, there's no reason they can't meet with their investors and talk to them every quarter, tell them generally how things are going, as long as they tell all the investors and not just inside information. But I do think that this would be very salutary in getting people to focus more in the long term. Right now, all the CEOs have to play the expectations game because the market demands it. If we can stretch it out to twice a year, I think it will get much more focused on strategy, give us more opportunities to invest longer term in research and development, new capital facilities, expenditures. So I'm very much favor the longer term. And I hope that we move in this direction. I think President Trump gets it right. So does Bryce.
Bryce, I want to zero in on something that Bill said. He said, as long as they tell all investors. And I have seen some critics of this proposal raise the concern that this would give large institutional investors and or hedge funds even more of an edge because they have sort of their proprietary ways of ferreting out data. Do you share that concern?
I don't. And again, because this has been done. It's been done for centuries. We know what semi-annual reporting looks like. London's not the only jurisdiction to have it. And we have deep, effective, accurately priced markets, and markets that attract investors because they seem fundamentally fair. I don't think that quarterly financial results materially change the picture of companies in the ways that some of the people who make this argument suggest. I think companies' performance is relatively predictable over such short periods of time. I also think that, in an era where there's index funds that just invest, regardless, apply no thought to the pricing of securities, having active information gathering investors helps produce efficient market prices, which, let's face it, is really what investors rely on. They rely on the market price to bear some resemblance to the underlying value of the business and its future cash flows. They're not themselves poring over quarterly financial results.
Right. And Bill, on the other hand, when we talk about some of the other changes or policies that this administration has put in place, things like tariffs, for example, is this sort of classic Trumpian look over here, don't look over here, or have companies adjusted to the tariffs and it's sort of they don't have anything to do with each other?
No, I don't think they have adjusted the tariffs, and we're going to see increasing inflation as a result of it. I think that's inevitable. And no, I think the president's serious about this. And by the way, one change it would bring about, Bryce, you've written on this, is I think it would get boards of directors more focused on strategy and building the business and long-term growth. Right now, their boards spend a lot of time worrying about quarterly earnings. Frankly, they have zero influence on the quarterly earnings. They can have a lot of influence on the longer term, and that's where they should be spending their time, looking at the culture of the company, how well it's true to its mission and values, and not focusing on the short term. Let management do that, and they produce the results every month, but it doesn't have to be public, so that becomes the focus of investors.
Bryce, to Bill's point, let's get to some of the other things that you talked about in your piece in terms of other sort of structural changes that could be made. And one of them does have to do with boards, which under regulations, you have to have independent board directors. Why is that not a good, it sounds good on paper, right? To have people who are not sort of buddy-buddy with the executives at the company.
Yeah, and independent directors are good. And there's some great independent directors out there. I'm an independent director, and I like to think I'm okay. The problem, though, is that we took a good idea and we turned it into almost the only idea we have about board composition. We now have boards where, in most boards, the only inside director is the CEO. And so you have a board that's entirely filled with individuals who only know what's going on in the company because they're told by the CEO, and whose only stake in the company is stock options and maybe a bit of reputation. but they don't have deep ties to the company the way inside directors do. And when you look at this point, 40 years of empirical research on boards with sort of all independent directors, you find in the research either they don't outperform boards with inside directors, or in many cases, they do worse.
Bryce, if I can just jump in here, Julie, and add to that. I like independent directors. I've been one, but I think they actually have to understand the business. And the governance gurus 10, 15, 20 years ago decided, if you were a customer of a company or a supplier, you couldn't be on the board. He can be the most valuable people. And we got to going to diversity. We went almost too far in looking at that as a primary criteria. I think we really look to have a board that's knowledgeable, former CEOs and people that know something about the business. And we've made it too hard for them to become independent directors. So I'd like to encourage that because I think that can be extremely helpful.
Bryce,
and if I can just add to what Bill says, this idea that independent directors should be the only directors on the board besides maybe the CEO is based on the idea that the only value that a board contributes is keeping an eye on the CEO, monitoring management. But anyone who's been in a boardroom realizes the real value directors give is in strategy and making connections and providing a sober second look and acting as a sounding board. Boards should be selected for those qualities, not just the empty category of doesn't know the CEO very well, may not like them.
Bryce, just to play devil's advocate for a moment, I mean, you could look at the U.S. Corporate in aggregate, corporations in aggregate. You could look at their performance. You could look at GDP growth. You could look at performance of the stock market. You could look at sort of business creation as well in the U.S. All of these things, on a relative basis, you could say are better than most other places in the world, right? So
they are.
What kind of upside could this unlock, or is this are we already sort of best in class in the U.S.?
Well, first of all, the United States, particularly its ecosystem for creating innovative companies, is, I think, rightly the envy of the world. So you're exactly right. So there are things we're doing that are really good. Most of that happens a bit downstream, though, of the public markets. What we've seen over the last 30 years is out of, let's say, 1,000, and this was a study performed a couple of years ago, out of 1,000 successful exits of venture capital companies. These are companies financed by venture capital firms that are successful. Less than 100 went public. That's what's changed. We've gone from a point in time when most companies went public to a point in time when virtually none of them do. And fixing that, I think, is really important for the United States.
Well, and
Yeah,
Bill, I mean, you've consulted to all kinds of companies, Bill. Do you think that this is these kinds of regulations are a real obstacle, and one of the reasons why we're not seeing some companies come public, or why we're seeing them balloon in valuation and still not coming public?
No doubt about that. I remember talking to Michael Dell at length about it years ago because he couldn't get enough opportunity to focus on rebuilding his company for the long term. And I think that's why companies are staying private right now, or going private. And I think it's a real concern because being in the public market is so much pressure on the short term that you can't build a company for the long term. The reason the U.S. is so innovative, the innovation is coming from small companies that are private. They're being funded by venture capital. And Americans in general are much more willing to take risks. In a lot of European countries, one failure in taking a risk is considered the end of your career, whereas in the United States, it's considered a learning experience. And I think this innovation we have here is absolutely critical. So let's not confuse cause and effect. I think the dynamism of the U.S. market comes from innovation and investments in innovation, and a lot of that's happening on the private side.
Bryce, one more quick one to you related to all of this. We are seeing almost an opening of the private markets. In other words, more access on the part of investors to invest in various ways. What are the risks of that? If these companies aren't going public, obviously they're less transparent in the private market. So do you run the risk of some individual investors running into trouble there?
Of course you do. And so we've had a strong prejudice for almost the entire history of securities regulation in the United States since the 1933 Act, we've had a bias against private companies letting individuals invest in them. But as the public markets shrink, and as they increasingly embrace a narrower and narrower slice of business, and as more and more economic activity occurs in the private markets, there is going to be, a really irresistible force drawing investors into the private markets.